Welcome to the InterMarket Analysis Update. This is being prepared for Tuesday, February 21st. What I try to do in this video is just look at a lot of different markets, compare them to the S&P 500. We also look at other indexes in the stock market and compare those to the S&P 500 to try to give us some insight that we may not get by just looking at S&P 500 charts. The first thing that we look at is valuation. How is the stock market valued currently? When we have a red line up here at the top, that's a PE ratio of 20. When we're at 20 or above on a trailing 12-month basis, that is considered to be expensive. And right now we're above that red line. If prices decline or if these lines go up and we get to the PE ratio of 15, that is considered to be fairly valued. If we drop all the way down to the green line, that is a PE ratio of 10, and that means the market is inexpensive or cheap. Down here on the bottom is just a difference between the S&P 500 and the red dashed line. When we're above zero, that means we're above the 20 PE ratio and considered to be expensive. Here's another chart just showing all the way back to 1980 how these different valuation levels have fared compared to what the S&P 500 has done. We had the 1987 crash, the dot-com boom and bust, the housing crisis, and then all of the things going through COVID up to the current time. The first area we look at is growth and value. Growth is where we get a lot of our upward movement from. These are the companies that you want to buy at 10 and sell at 20 because they have a lot of growth potential. When these stocks are really suffering, the market is tending to suffer as well. Well, if we just look at a growth index, we are still in a downtrend. We're seeing some improvement overall, but the blue line is still below the red line. The other area is value. These are companies that produce things that may not be as flashy or as wonderful to talk about at parties, but they still form a real backbone of the U.S. economy. These stocks have been in an overall uptrend, and over 2022 and now into 2023, they're still faring quite well. Now we compare the two. The top chart is a ratio of growth to value, showing how growth is underperformed. The bottom chart is showing how value has outperformed. Here's another look using some indexes showing how growth has been really underperforming. This is an inverse of that same chart showing how value has been doing quite well. Here's some ETFs showing how the growth ETFs are underperforming while the value ETFs have been outperforming. And then the last chart is just a growth to value looking at some other indexes where we've been in an overall downtrend. Some other markets are the dynamic software companies. These are the 30 biggest U.S. software companies. We're getting really close to a golden cross, but we haven't seen that yet. Looking at an inflation chart, this chart attempts to measure inflation against deflation. Inflation, that would mean this chart is going up. When we see deflation, that means this chart is going down. And so we've been seeing deflation start to come into the market more, and inflation has been going down. Another thing that we look at for an inflation gauge is the Baltic Dry Index. How much does it cost to move products from one point to another? It really spiked up in the latter part of 2021 and spent a lot of 2022 and now into 2023 declining. So this is suggesting that inflation is more under control, but we're not seeing that in other indexes or other measurements that we use. CRB index is another measurement of inflation. It had really been going up and is now in an overall downtrend. It's still pretty high, but it's well off of the levels where it had been. Corn, after spiking up and coming back down, has pretty much stabilized lately. Aluminum, another thing that really spiked up and has been coming back down. Heating oil, spiking up and also coming back down. Gas, spiking up, coming back down. So a lot of these charts are just suggesting what we're hearing in the financial media and what we're seeing in the reports is that inflation may have topped out in about June of 2022 and it since has been coming down. What we're concerned with now is it going to re-peak? Is inflation going to come back into the market and we're going to see prices go back up? That's what we're looking at all these different charts to try to understand. Natural gas, after really spiking up, has gone way back down. It spiked up to 10 and now it's at 2.28. Oil is under $80 a barrel at $76.55. Diesel, after going up really high, has been coming back down. Wheat has also been coming down after spiking up. Fertilizer, after spiking up, has also been coming back down. Lumber is now in a downtrend again. It was starting to go back up right at the beginning of the year, but since has turned back down. The dollar was really strong in 2022, saw some weakness going into the latter part of 2022, but we're starting to see what could be a bounce. Comparing the euro to the US dollar, the dollar has been declining, the euro was going up, but now we're seeing a potential reversal. And the Japanese yen also has been going up and has been coming back down lately, as has the euro against the US dollar. Here's the British pound, after giving us a recent golden cross against the US dollar, has now been falling back below both moving averages. The Japanese yen, also a recent golden cross, but showing some weakness. Copper, we'd like to look at this. When copper prices are going up, that generally means good economic forecasts going forward. If copper is going down, that means the opposite. We had a recent golden cross here, and copper's been bouncing all around, but it's still in an overall uptrend. The copper to gold ratio just shows how copper has been outperforming gold. And here's a longer term look at that same chart, comparing it to the 2-year yield. We tend to get not very far apart with the yield and the copper to gold ratio. Right now, they're very far apart from each other, and they have a tendency to go in the same direction, but they're not doing that right now. Gold, after giving a recent golden cross, has shown a lot of weakness. The same thing is true with silver. Looking at some different indexes, the CRB, which measures inflation against the S&P 500, the CRB had really outperformed in 2022, but now we're seeing a death cross with this ratio, and now the S&P is beginning to outperform, which is what we see in this next chart. NASDAQ 100 compared to the S&P 500 shows that the NASDAQ 100, which is where a lot of growth stocks are located, they continue to underperform the S&P. Looking at the S&P and some other stocks, we have the Mega Cap Growth ETF. These are the big companies, the Apples, the Googles, the Microsoft. They're showing some improvement lately, but not enough to give us a golden cross. The Mega Cap Growth against an equal weight version of the S&P 500 shows how the Mega Caps have been underperforming. The S&P 100 has been underperforming the S&P 500. The S&P 100 are the 100 biggest stocks in the S&P 500. Small caps have been doing fairly well lately. They're starting to outperform the S&P. They're in an overall uptrend. Low volatility stocks, after giving us a recent golden cross, have really been chopping sideways. These are the ones that hold up better well when the market's running into trouble. Doesn't mean they go down. It's just they might go down less than some of the other stocks. So when you look at a ratio of the low volatility stocks to the S&P, we're still in an overall uptrend, but we've seen some recent weakness. The Dow Jones Composite Average takes the Dow, the transports, and the utilities and puts them together into one index, and this is still in an overall uptrend. Looking at Dow theory, we're seeing how the transports really started to break out, and that was not confirmed by the Dow. And we're also seeing some weakness in utilities, which is not being confirmed by the Dow either. So we're seeing a little bit of divergence here. We just want to keep an eye on this. If we see continued weakness in utilities, that could help stocks, because when the S&P outperforms utilities, it tends to do quite well. The transports are a real backbone of the economy as well. But after really going up in the latter part of 2022, the Dow has pretty much been chopping sideways since the beginning of December. Here's another way of looking at Dow theory. We have the S&P 500 on top, and it was starting to break out, but is now coming back down. And then we have the NASDAQ down below, where it is breaking out, but also showing some weakness. Will it drop below this previous high that was set? FANG stocks getting really close to a golden cross, but not there yet. ARK is a long way from a golden cross, but still showing some improvement. It bottomed in just below 30, and now it's into the 40 range. High beta stocks, these tend to outperform on the way up. Unfortunately, they also outperform on the way down. We're seeing high beta stocks still doing well. When this is going up and we see a blue line here, that means more risk on. Folks are willing to get more into stocks. When we see a red line and this ratio is going down, that's called risk off, and people are getting out of the stock market and getting into other investments that are considered to be less risky. Here's a ratio of the S&P 500 to some international stocks that go through Europe, Australia, Asia, and the Far East. still shows that the S&P is outperforming, even though it's showing some recent weakness. On the bottom, we're looking at the percentage price oscillator, and we want to see that turn back up for things to turn more healthy. One thing to be aware of, this is a monthly chart, so it goes back a long time, and it takes a long time for these things to change on this chart. Looking at bonds, we have a number of our yield curves that are inverted right now, and I pretty much go through a list of these every day in the daily brief. The total bond ETF is giving us a recent golden cross, although we've seen some weakness this past week as interest rates have gone up and bond prices have gone down. Here's a world bond index, just getting close to giving us a golden cross. We're really getting whipsawed around these moving averages. The stock to bond monthly ratio shows how stocks are continuing to outperform bonds. And this also shows that as well, where bonds are underperforming stocks. Here's a high corporate bond ETF where we had a recent golden cross. Looked like it was breaking out, but seeing some recent weakness. And the same thing is true with the investment grade corporate bond ETF. Stock to bond correlation, almost near the neutral area. When we're at 0.25 and below, all the way down to minus 0.25, that's neutral. When we get above 0.25, that means they're having a slight tendency to go in the same direction. When we get to minus 0.25 or below, they're going in opposite directions. Well, stocks and bonds are having a slight tendency to go in the same direction. Here's the Dow Jones Corporate Bond Index. After giving us a recent golden cross, is now showing some weakness. Here's the 10-year Treasury yield, which is starting to go back up. Here's another look at that as well. We're currently at 3.828%. And here's another one showing the yield of the 10-year bond, where we came all the way down to the 200-day moving average. We're bouncing up off of that, and interest rates are continuing to go back up. Here's the 30-year yield at 3.88%, starting to go back up. The S&P 500 to the 10-year Treasury yield shows how interest rates have gone up a lot faster than the S&P. So the S&P is underperforming. Junk bonds, which tend to mirror more what's happening in the stock market, these are riskier bonds that also can give you a better return, and folks like to get into them when they're not really getting any kind of return from Treasury bonds. We saw a recent golden cross, but also weakness. Here's the junk bond ratio to the government bond ratio, showing how the junk bonds have continued to outperform. And here's the 7 to 10-year Treasury bond. This is based on price. So bond prices are going down. That means interest rates are going up. We also have the MACD, which is in a downtrend. And recently we also dropped below 50 with the RSI. That's more negative. Here's a daily chart showing yields where we had been coming down, but over the past week or so, and in getting into the middle part of February, we've seen interest rates start to go back up. Here's a weekly chart of the US, UK, and German bonds, how they're going back up, and then Japan, which is kind of fighting their own little story right now. Their rates are going up, but they're much lower than other countries. Looking at some different sectors, as I mentioned earlier, when the S&P is outperforming the utilities, that tends to do well for the S&P itself. It had been trying to go back up, but recently we're seeing some weakness. The staples, these are things you have to have no matter what's going on in the economy. After giving us a recent golden cross, have now started to come back down. Energy against the S&P, that's been the place to be in 2022. We're seeing some recent weakness this past week in energy, but it's still in an overall uptrend compared to the S&P. The tech sector, we're getting really close to giving us a golden cross. Semis did give us a golden cross and are still looking much better, even though they had a fairly difficult week last week. And the tech sector is starting to come back up and showing some improvement when compared to the S&P, but is still in an overall downtrend. Discretionary to the S&P, discretionary are the things that make life fun. On the top, we have the S&P 500. It shows how discretionary has been underperforming the S&P, but has been showing some improvement since the beginning of 2023. Here's the energy sector, which continues to be in an uptrend compared to the S&P. Materials, which are also in an uptrend compared to the S&P, and the financials are also in an uptrend. Real estate, which is underperforming currently compared to the S&P. Utilities, which I just mentioned, after trying to give us a golden cross, immediately came back down and gave us now another death cross based on this ratio. Healthcare has also been in an overall uptrend, but we're seeing some weakness here not enough yet to really trigger any kind of a cross. Here's another look at the healthcare to S&P 500 ratio, how healthcare had been really outperforming, but then as the market was going up at the beginning of the year, healthcare was really going down. Communication, these are the Google, the internet companies, and a lot of the real cutting edge growth companies. They continue to be in a downtrend compared to the S&P. Staples, again, the things that you have to have no matter what's going on, continue to be in an overall uptrend, but showing some recent weakness. Industrials are in an uptrend compared to the S&P. And the NASDAQ against the S&P 500 shows how the NASDAQ has been underperforming, but really bouncing back at the beginning of 2023. And here's the NASDAQ 100 compared to the NASDAQ. And the NASDAQ 100 continues to outperform the NASDAQ, even though it saw some recent weakness. Some other areas, growth, which are the big companies that we like to get into to buy low and sell high, compared to bonds. In 2022, both had a really bad year, but growth has been continuing to outperform bonds, and we're getting close to a golden cross for this ratio. The 10-year Treasury yield has been really outperforming the tech sector. And here's the tech sector, which has been underperforming the 10-year yield. Discretionary against staples show how discretionary has been underperforming. We're trying to make a bounce back, but not enough to give us a golden cross. And then staples have been really outperforming discretionary, but seeing some recent weakness. Energy to the tech sector. Energy has been really going up, showing some weakness now, but still in an overall uptrend. Gold, after trying to break out many times, is still in an uptrend compared to the S&P, but really coming back down. Gold to the US dollar. Gold had been really climbing. Now, as the dollar's been going up and gold has been going down, we're seeing this ratio go down. High leverage loans, these are pretty risky loans. And if the economy was getting ready to really have some trouble, you wouldn't expect these to be going higher. Well, that's what they're doing. We had a recent golden cross, and these are performing quite well. And then looking at the 3 to 7 year bonds and then comparing them to investment grade bonds, when we're going up, that means that fear is increasing. So read this like you would the VIX. When this is going down, that means fear is decreasing, and I have a blue line here. Well, at the beginning of the year, fear had really been decreasing, but now we're seeing it go back up. Our InterMarket Analysis chart shows going back to the beginning of 2022, how oil has been performing best, followed by the dollar. Gold is just barely positive, where stocks and bonds continue to be negative. Looking at some indexes, this is the American Stock Exchange, the NASDAQ, and the NYSE. We take all the highs minus the lows for those three exchanges, take a 5-period moving average of that to get a real broad base of the internal strength of the market. When we're above zero, that's positive. When we're below zero, that's negative. We're currently above zero. The small cap index did really well on Friday and was up on the week after giving us a recent golden cross, but it hit this R1 level as resistance and has been backing down. Here's another small cap index, the Russell 2000. After hitting resistance right at the beginning of February, it's come back down and hit support, which are the highs set back in November, and it's been trying to bounce back up. On the bottom, we have a MACD, which is showing a downtrend, but we're still above 50 on the RSI. The mid caps, after hitting this resistance level, have also been backing down, but still in an overall uptrend. The Dow been chopping sideways after giving us a recent golden cross, and we were able to get back above this pivot. Anything above this pivot is positive for the month. Everything below is negative. The Elder Impulse system based on the diamonds is still showing a negative trend. The NASDAQ is also in a downtrend after hitting resistance and backing down. Here's the Fibonacci measurement of the all-time high going back to the lows set in October, where we never did reach this 38.2% retracement. With the NASDAQ 100, we're not at a cross yet. We came up to this R1 level and have been coming back down. And our Elder Impulse system is also a negative. And then here's a Fibonacci measurement looking from the all-time high to the lows set last fall, where we came back up to this 38.2% retracement, and that has been overhead resistance. The NYSE composite is still in an overall uptrend. The Wilshire just gave us a recent golden cross and has been holding up fairly well. All stocks also a recent golden cross and are in an overall uptrend. Emerging markets also a recent golden cross. Looking internationally, China's been having some trouble. The emerging markets are going back down. Europe is also in an overall downtrend as Japan is, and then the S&P is starting to roll over. Bitcoin is still in an overall downtrend, but was able to get back up into the 25,000 range before dropping back down slightly. Looking at some correlations, this is the S&P to the dollar. It's pretty much of a neutral relationship now. The same thing S&P and oil, they are neutral. S&P to the 10-year also giving us a neutral reading. And also neutral is the tech sector to the 10-year yield. The S&P to the 2-year yield is also neutral. And then looking at the small caps against the S&P 500, that's this red line. When we're really breaking out with the small caps, that can really help the blue line, which is the S&P 500. And then we set a low back in October with our NYSE breadth thrust, and now we're coming up out of that. That is a longer-term positive signal. Doesn't mean we're going to go up from here, but it does bode well looking out 1 to 2 to 3 years. The 2-year Treasury yield, we had been spiking and then we're going back down with the yield. Now we're starting to come back up again and we may take out this spike. The staples, the S&P 500, after giving us a spike and coming back down, and that usually gives some really good support to the S&P, it's coming back up, but it's still far away from the spike. Home builders, we want to watch this, especially when we see divergences here. If the home builders are starting to go lower while the S&P is going up, that's a real warning sign. Right now, they're pretty much going in the same direction overall, so not really flashing anything out of the ordinary. Looking at some really long-term starts, here's the ICE Bank of America High Yield Index. This is in an overall uptrend, even though it's seen some recent weakness. What we look at on the bottom is the KST. Then on top is the S&P 500. And we, again, want to look at this similar to how we would look at the VIX. If this is going up, that means there's more fear in the market. When it's coming down, that means there's less fear. So this is more of a positive look on this chart. Then the NYSE composite, a monthly chart with the Copic curve. It's trying to roll over and go back up, but it hasn't quite done that yet. And here's also the NYSE composite with the NYSE record high percent index after bottoming and coming back up. That could be very positive for the markets as well. And if the NYSE is doing better, chances are the S&P 500 is also doing better. Here's the S&P on the top with a monthly chart showing the PPO. It's starting to go back up. That's a momentum oscillator. Looking at a ratio between the S&P and the CRB index, the S&P is just starting to outperform the CRB. Here's the S&P, and then looking at a global index where the S&P continues to be in an overall uptrend, but we're seeing a bit of a rollover with the KST. We want to keep an eye on that. All right, so what's positive then? The value indexes are still positive. The euro, the Japanese yen, and the British pound are still positive. Copper, gold, and silver. Low volatility stocks, the Dow Jones Composite Average, bonds, either the ETF, the high yield and investment grade bonds, world bonds, as well as corporate bonds. Even though they've seen some recent weakness, they're still in overall uptrends. Junk bonds, staples, semiconductors, high leverage loans, small caps, mid caps, and the Dow, and the NYSE Composite as well as the Wilshire, all stocks. And then emerging markets are still in overall uptrends. What are negative? The growth areas are still negative. The big software companies, CRB index, the dollar, mega cap stocks, FANG, ARK, tech, the NASDAQ and NASDAQ 100 continue to be in downtrends, and Bitcoin. Thank you. I hope you found this insightful. I will also be preparing 2 more videos. One I call the deep dive video where I look at the charts that I don't really cover in the past week or so, and then I'll be doing a supplemental video mainly looking at the Isabel Net charts. So I will talk to you in the next video.